Holiday shortened week. Volumes were down significantly for most of the week, but there's a lot of news and there was a lot of price action that is going to lead me to kind of take you through back on regime shifts, which I talked about in December. There's more relevance as to what the regime is, and that's the first point here. Is it's clear that at this point, stagflation has entered, and I think that's going to be the regime for the near term because of the fact that any inflation data that goes higher, which I think is likely because of the commodity side, but also because growth is a worry. Part of it is because of what Doge is doing and cutting spending. Part of it is the AI side, and I think what's going to continue to show up is weakish labor. And at the same time, with the tariffs sitting out there, when they happen, they kind of fit into both camps. So I'll go through that. Momentum stocks had a big fall. That is usually a turning sign. And this time when they fell, it feeds into the third part, which is I'm going to go through the equal weight pairs, which have finally been breaking down. This week they broke down, and I'll show you those. A very good leading indicator for the S&P 500. Grok 3 came out. Big deal. I used it all week. It has supplanted some of the AI work that I was doing on Perplexity and Claude. This just continues to stair step in terms of AI. Very big week for humanoids. I'll go through that. And then there was a crypto hack. So crypto just continues to have what I would consider to be bad news coming out. And I'll kind of go through the charts there on both the crypto universe, ex-Bitcoin and Bitcoin. Just for the week, S&P down 1.66%. The thing that stands out, you got utilities, healthcare, energy, staples, basically the defensives plus energy on the inflation side outperforming, and all of the negatives are related to growth. So again, immediately think stagflation, not inflation and not a recession, but stagflation. So slowing growth at the same time that inflation is going higher. Year to date, same story. Staples, healthcare, utilities, energy. You've got financials up here, but you have the growth-related names, which are down here, including technology. Remember, I showed a regime shift warning back in December. This was December 15th when I did this video, and I showed how momentum had gotten hit, and this historically leads to the probability of regime shift. I now think we've confirmed the regime shift because we have a story for it. And once you get a story for it, then people can start to be scared about it. So Steve Cohen came out this week and basically said exactly kind of that part, which is we're going to see growth slow in the second. Tariffs, tighter immigration, which people expect to have an impact on unemployment. The government cost cutting by Elon Musk, and the tariffs. So you have people starting to talk about it. And again, sticky inflation, I agree with, slowing growth, just not accelerating growth. And I think that's what people were positioned for. People got positioned for inflation going higher, but on cyclical growth, which we've seen in the PMI. But now the fear has shifted to the slowdown. And I had talked about the dilemma the Fed would probably have this year, because I thought the labor market would be on the weaker side. Now what they've thrown in is that Doge is going to be more successful, but if you're going to cut hundreds of billions of dollars from spending, it will have an impact on the economy. If you're going to fire hundreds of thousands of employees, or let's assume more than 100,000 employees, it's going to have an impact on the claims, and I think that'll just keep things on the softer side. So you started to get the news items towards the middle of the week. This is before the Friday movement, but stagflation is poised for a comeback. And remember, I highlighted this last week. Last week started this whole thing off in terms of the regime. And I just want to emphasize again, as I go through this, I do not think any chance of a recession. Nothing has changed there unless they somehow or another do tariffs very aggressively and at the same time cut spending very aggressively. Otherwise, I think this is going to be a battle where AI will continue to make profit margins good. The stock market will change. And what we've had is companies like Palantir, companies like Walmart, companies that are trading at whatever PEs wanted, where we haven't had a correction. Now we're in a different regime. This regime is where we have growth slowing, so the probability of recession by definition goes higher, and we have inflation at 30-year highs X for a month-over-month number, COVID, which increases the probability that the Fed could raise rates. And again, I don't think either of those things are going to happen, but the market is about how they were positioned, and they were positioned for growth to accelerate while inflation stayed down or continued to trend lower. Here's the Philly Fed prices paid, and this is not just about this number, which gets you back to the 2022 levels, October 2022. It's more about, you can see how this is trending higher. We're done with the disinflationary or the inflation heading back scenario at this point. You've got too many data points that are coming out. And again, it doesn't mean we're going back in terms of the CPI levels back up there, but since the commodity stuff is heading higher at this point, a 4% inflation at some point this year, year over year, is a good possibility. Here's the 1 year UMISH, 1 year expectations of inflation up to 3.5%. This is the highest level in 30 years. So you've got expectations moving higher. And then even the Fed, this is the number of participants. The yellow line here is worried about the unemployment rate in terms of it going higher. So that's come down. But on the inflation side, risk to core PCE, it's also at the highest level since back in Q4 of 2022. So you're getting all kinds of stuff on that side, and then the market has been building it in. And I showed this chart last week. It continued this week. It's actually accelerated. We broke through 4% on 1 year. So these are break evens for tips. You're up at 4% in terms of 1 year expectations. You have the 2 year up at over 3% at about 320. And again, that's higher than any point since this little spike here in March of 23 when we were still technically in it. So you've got this going higher. Here, 2 year break even, showing that chart a little bit closer and just heading back up there. What it has done, and what I tweeted about this week, when you're looking for reasons that the dollar is coming down, this has been the relationship between real 2 year yields. And we haven't talked about real 2 year yields in a while, but the Fed is on hold. So as inflation expectations are moving higher, we're not moving 2 year rates higher. So you're seeing real rates come down. And so at this point, now the dollar has followed this. And this is why at this point, when we had this going on, we expected inflation to go higher with growth. If you have inflation going higher without growth, well, that's a difficult situation, and that's where you end up where people start questioning the views they had. That is a momentum trade that has been trending the other way in terms of a strong dollar is now turned into a weaker dollar. Another trend, you've got rates that have come down. And again, I've highlighted the fact that we have a MACD weekly sell signal. We had a little upward move, but with inflation coming down, the market is getting out of the positioning that had been expecting inflation to go higher, but with growth going higher as Trump took over. So that's the big thing that has shifted. We got economic data this week, and I think this stuff starts to tell the situation that feeds into the tariff argument that I've made, which is this is the unemployment rate. This is the 10-month average of it. It's inverted. So the unemployment rate is still very much at very good levels. At the same time, you have stock ownership. This is the UMISH sentiment number. So stock ownership is up here. So it says people have owned a lot of stocks, and we've seen the stock market go up significantly, but this is the expectation of their financials 1 year out. So you're getting a huge disconnect right now where people are just not happy with where they are. I think that is the job situation. I think that is the inflation situation. And I think we're left with a scenario that people just don't think they can get an increase in wages of any meaningful number. And the cost for everything in their lives just remains on the high side. And they keep getting hit by things, whether it's insurance on car, whether it's food at the supermarket. Every time there's a little uptick, it starts to have sensitivity. So I've shown this chart before. Inflation expectations last week, again, this is through the 2s10 swap curve for inflation. Again, they're up at these levels, and here's what the chart looks like of the Mag 7. The Mag 7 is now down for the year, and it has the look of a topping formation. And again, I bring this up. I had these two lines in here because this is when the Fed pivoted and said they were focused on inflation, and then this is where they pivoted the other way. So this is the end of transitory. And they're going to start fighting it. And you saw what happened to this. If inflation is more than sticky, the risk of this happening has gone up. And that's just the issue that comes up. I don't think you're going to see inflation get to those levels. But again, people were positioned for disinflation and growth, and that's not happening. And so momentum starts to shift. This is the weekly momentum. So remember, I highlighted in December, you had some big days, but there weren't big weeks. This is the biggest week since the pivot week. And again, you start going through this, you start recognizing that, okay, we start getting these big weekly shifts. That means that people are positioned the wrong way for the macro environment, and that's what I think has occurred. I'm highlighting this. You had two big down days in a row. You had a whole week was down every day, but these 2 days, this is the one that happened in January. This was DeepSeek. So you had the tech side that had gone out and all the trades, the power trade. I bring this up because momentum takes time to shift the other direction, but as hedge funds start losing money, and those are the ones that start going in, as quant strategies start repositioning because of new macro news, you will get a shift. A regime is about a macro change. It forces quant strategies that use things like the dollar, that use things like real 2U rates, that use things like commodities. When you have the inflationary side trending, then you start to get shifts the other way. And that's what's happening in my opinion. But also there's an expectation by discretionary people that growth could be at risk because of what's happening. So anything that makes this worse, you're going to continue to see pressure on this. At a minimum, when you've seen these three, this is the one in December when I highlighted it the first time, you're obviously also getting a change in volatility. So this is the 60-day vol for momentum. Aside from this period in 2022, and again, this is the pivot point by the Fed. You get a pivot, you get a massive change in vol because everyone needs to reposition their portfolios. Remember, a pure momentum factor is market neutral. It is sector neutralized. So this is really an important move when you start seeing a shift in volatility. That means you're starting to get people that are bailing out of things that have worked for a while. And again, I use Palantir as an example. If you look at that chart, I bring Walmart up. These were darlings that retail and everyone could stay long. There was no reason to get out of them. Well, we just saw big moves the other direction. And what it led to, and this is sector momentum. So this is highlighting, this one here, the blue one is TMT. So the technology side went down. Healthcare had already been in this. I've shown this repeatedly. This is pure momentum, which is still lagging behind, but the trend is there. And I bring it up because I would not be surprised if this rotation should happen, but it needs a macro context, needs a story. And that's the one thing I've learned is that from a risk management basis, you want to hear this stuff because you want to look for changes. This is the way it fits into the bigger picture. So I mentioned these equal weight pairs. This is the S&P equal weight consumer discretionary relative to the equal weight consumer staples. So it takes the cap side out, which makes it a much better indicator for what's happening both at the quant level, but really it's the best indicator in my opinion, or one of the best ones, and I'll show you another one as we go through this, for the economy and expectations on it. So this is it overlaid with momentum. So again, when people start getting out of cyclical and they start getting into defensives or into staples, so this is consumer discretionary versus consumer staples, one of the most important ones. That's a sharp move and they move together. That means it's being driven momentum by changes in the economy. So from a macro basis, you're getting the signal. This is the daily move. We had the weekly move. We had the biggest weekly move drop in the equal consumer discretionary versus consumer staples since all the way back in 2020. So you have to think about it. We had negative real GDP here, but that was with high nominal GDP. We now have nominal GDP around 4.5% to 5%, with inflation heading back or appearing to head back to 4%. That's a very different scenario than having 12% nominal GDP and inflation going up to 9 or 10 and seeing a negative print. So that's why you're getting this massive shock that takes us back there. But you can also see how many weeks in a row we had a big move. So this was a very crowded position. Very important to monitor because I do think it has changed. And just to show how correlated it is to the S&P, this is the S&P since the lows in March of 2020. I haven't highlighted this because there was really no reason, but whenever the S&P has had a mini correction here, this has made new highs. So it hasn't bothered me at all. It's one of the reasons why I look at this. But what you can see is this is a sharp fall that's equivalent to the S&P of about another 5 to 6% fall. We'll see what happens on this. I think this is more about a rotation, but the risk of a bigger correction in the S&P is there because as hedge funds are losing money, they will be repositioning and they will buy puts on the S&P. That is just the normal thing because people try to stop pain and it causes markets to go down on almost any rotation I've ever seen. This is just highlighting how it leads. So this is how it led the peak in 21. This is the transitory time, and the S&P eventually followed it down. And again, the white line here is the equal weight consumer discretionary versus consumer staples. So I just wanted to show that now we have a MACD. These weekly MACD sell signals have been working very well. Most of them, some of you're getting a lot of long-term trend changes right now, and I think with the momentum side already showing on rates, already showing on the dollar, showing on S&P versus the DAX, a lot of different trades, China versus mega cap techs. You've had a lot of what I would consider to be more value-related trades, and that's what I think this rotation is more about. But you have to pay attention that when stagflation becomes a story, we've left the world of higher growth, inflation trending lower, and now we're at a point where inflation, it's going higher, sticky, but trending higher, and growth, I'm a little bit more worried based on the policies that I'm seeing, where people were positioned for pro-growth stories. So that's the shift that's happened. You can see this sharp move lower. We're right at the 20-week moving average. We'll see if we continue on this, but I think we've got enough on that to signal that there could be some risk. This is another way to look at it. This is another equal weight pair. So this is the equal weight cyclicals versus defensive. So similar to consumer discretionary versus this, another big move lower, much bigger in terms of relative to the move. So it gave up everything back to October, back to the election when we had gone higher, and basically in one day. And again, leading indicator, it led here in the same way. So you've got all these pairs on the equal weight side, which suggest it. And then on this one, a little worse of a weekly MACD setup. You've got lower MACDs and higher prices, so you've got these divergences. So everything looks to me like we're going to get some kind of a shift. And it comes at a time where we've been seeing, again, cash levels go down. I never care about the level. I mean, you could have said it was low here. You could have said it was low here. But what you want to look for is warning signs that are happening. So we have low cash levels, which means we don't have people fearful. At the same time that we're seeing the internals in the market change, it comes at a time where everyone wants to talk about how expensive it is. I don't buy into this in terms of this. With the profit margins are at all-time highs, as I've shown. That's why I don't worry about the market. But you want to be in a position where you can take advantage of people getting short and bearish, and they have enough of a story, so you look for where the stories could be. Delinquencies. We've got delinquencies that have been trending higher since 2022. You've got a lot of people, the median voter, but definitely the bottom end, which has been suffering, and they're suffering because rates have gone higher. Now with inflation going higher, you have that problem, and I just think the wage problem, or at least the problem with the job situation, is going to remain on the softer side. The good news is, as I showed last week, the AII retail survey it's low. So sentiment is already negative for traders. Just highlights that we're at 40% bears. Normally, you're at 31%. The bulls are at 29. A high level is 52. So we're really extreme in terms of the sentiment side. I just want to keep reiterating that the tariff side, to me, is going to end up, if he does tariffs at a time when we've got this stagflation fear, I think it's going to have an impact on the market. It's one thing to do it at a time when there's none of this going on and people don't have to worry. But as I said last week, he paused them. And I think one of the reasons that he paused them, because he clearly really wants to do them, is because of the fact that inflation was higher. Well, if the market is going lower, the reason I wanted to bring this up, here is the income tax side. These are the duties collected on steel and aluminum from 2018 to 2024. This is from Apollo. And the reason this is so important is because the $3 trillion of personal and corporate income tax, a lot of that has to do with the S&P 500, as I showed last week. So if S&P 500 goes down, it's a much bigger number. The S&P 500 is far bigger. So when you're doing the calculation on what Doge can get away with and with what tariffs can get done, the assumption is that we raise tariffs and everything stays the same. The revenue side is much more volatile than people give it credit for, because if you have a scenario that the stock market goes down, I just don't think it's going to go. So it weakens his ability to be too aggressive on tariffs, which will be a positive at some point this year. So I differ with Steve Cohen. I'm less worried about the tariffs in the second half of the year. I think right now we're getting a lot of warning signs that people are going to reposition. I think it's a rotation. I don't think you're going to see a big correction. I think if it is, it's kind of one of these rolling tops that's very difficult to trade. We could even make new highs during it on the rotation, but I think it's going to be challenging. One of the most important things for next week, we have NVIDIA earnings. Obviously, NVIDIA has the fear of NVIDIA on the back of DeepSeek makes this earnings report a lot more important than prior ones. So that could change everything for at least a bounce. In terms of AI, Grok 3 came out. If you haven't used it, I'll say the same thing that I did. It's free for now. I would highly recommend using it because if you don't pay for the $20 for ChatGPT, you're going to notice a dramatic difference with Grok 3 because Grok 3 is more equivalent to the higher end ones. So you get to try something that is free, which is much, much faster than anything in terms of perplexity or anything that goes through. So you can see the numbers. I bring this up because you got DeepSeek, they jumped to one. Then OpenAI came out with their next one, they jumped ahead. Now Grok is. The speed of AI change just continues to grow. And in the same way that we saw that DeepSeek was at the top of apps, well, look what's gone down now. DeepSeek is number 4, Grok is number 1, ChatGPT is number 2. So even the argument that DeepSeek would change everything on NVIDIA is not there, and that's why I wanted to bring up this. For those of you who don't know, Grok 3 is powered by Colossus. This is an amazing story. Elon Musk built this in, I think, 122 days. He expanded it over 92 days to get it to 200,000 GPUs. So anyone who was saying that what DeepSeek would do is stop the CapEx spend, what he has proven with Grok 3 is that more power and more compute does mean faster, better, everything. And he did this in a short amount of time. So I just wouldn't underestimate how much more we're going to be dealing with in terms of the compute side. So NVIDIA, at least for the next 2 years, the stock could have, it's going to have less multiple expansion in my point, but I think the demand side is going to be there. So it'll be a good indicator not of whether they're going to be able to go up 100% a year anymore. That I highly doubt is going to happen, but I do think they can certainly grow their earnings at a time where their PEs have already compressed over the last 7 months, because remember, their stock is basically unchanged since June, July of last year. Microsoft made a huge advancement in quantum computing breakthrough. Go read about that. Microsoft announced, and OpenAI did, that GPT-5 is coming out soon, and GPT-4.5 could arrive as soon as next week. So again, we're continuing to see the leapfrogging of all of this. I paid for OpenAI's deep research, so I jumped into the $200 a month club. Amazing. I've used it probably 12 or 13 hours this week. Grok 3 has been my dominant thing, so I've spent a lot of time on AI this week building some stuff. It's absolutely amazing. A lot of advancements on the biology side, again, so for longevity and all these things. Longevity is a massively bullish thing. It's something that will continue to be there. We're going to have tremendous amounts of drugs that come out. Google announced something in terms of discovering their AI agent, a new leukemia drug, then successfully tested in vitro at clinical concentration. So independently discovered. We're getting AI agents to make discoveries. Anthropic is coming out with a reasoning model. It said within a few weeks. So you're going to have Claude stepping up or Anthropic stepping up. If you guys haven't read this, on the Arc Institute, this came out this week in collaboration with NVIDIA. Can now model and design the genetic code for all domains of life with EV2. If you're interested in it, the All In podcast did about a half hour on it. Amazingly interesting in terms of what's coming and taking it from a different perspective of AlphaFold and some of the stem cell side. So highly recommend spending the time on it. Again, not an investment theme other than from a macro basis, it's very bullish for stocks. It's very bullish for everything because longevity is just a massively bullish theme in terms of reduction of costs and reduction of wasted spending on healthcare. So you're going to see that change. Elon Musk said this week on a panel, the biggest ROI from AI will be humanoid robots. So I've talked a lot about humanoids. I'm going to keep doing it because I think this is the year, I thought it was the year, that they would become a market-moving event. And I think we're getting to that point now. Brett Adcock from Figure AI basically introduced Helix. Um, if you haven't watched these videos, I mean, these are two robots that are working in the kitchen together. You should go watch the video. You can go to his tweet there and get it. Um, Basically, that company is in talks to raise 1.5 billion. That would be 15 times its last round. So 15 times higher than Figure AI's 2.6 billion post-money valuation last year. So you're talking about massive valuation jumps, and I just want you to, again, you go back to Elon Musk what he said, and he also said it would be a $10 trillion opportunity. You've had investors say Tesla would be a $10 trillion company because of humanoids by 2030. I'm just going to bring up now the other ones, and all of these you can go watch. This is the Unitree one selling for 16,000. This is China. Norway, and these is all this week. So this is all videos and stuff that came out this week. Obviously, people looking for funding and more money. It's going to take a lot of money for these things because they're not cheap to build. This is a Norwegian robotics firm. So we showed a US one, we've shown a China one, now we've got a Norwegian one. Unveiled its latest home robot, Neo Gamma, which is for the home. You can go watch that video also on Twitter. You've got Protoclone, created by a Polish startup robotics one. This came out this week in terms of showing it. Just going back to the AI, went back to the last one. So that's the message that we've got on humanoids. I wanted to finish up. I didn't really want to spend too much time on Bitcoin this week, given the fact that we remain stuck in this range. We've been in this range. We had broken out briefly and looked like all the stuff was starting to trend higher. And then all of a sudden we had a hack, which I'll get into in a second. But one of the things I did want to show with Bitcoin sitting in this range, we're really seeing a decline in volatility. And I think that's one of the things that is happening as Michael Saylor continues to do another issuance, which he did this week. You're starting to see the volatility of Bitcoin come down. So as volatility, and we're having hacks and we're having meme coins and all this stuff going on, volatility on Bitcoin is just dropping. So you're getting down to low levels. This is on IBIT, so this is the iShare. This will give institutions much more comfort that it can handle these days where you have this really negative news. So this is the hack, $1.4 billion worth of Ethereum on Bybit. So that happened this week. It was announced that we had record-breaking token creation in January. So think of it as we had record IPOs, which again, draining altcoin liquidity. Then you've got the meme coins from both Trump and from Malay, which ended up being a big negative. And with all of that going on, here's what's happened. So this is the overlay of the market cap of crypto ex Bitcoin relative to Bitcoin. So again, it's basically, in this case, the crypto market is unchanged since March of last year. So you're almost at the point where it's unchanged since there. At the same time, Bitcoin has outperformed it by 66%. So Bitcoin since this point is up about 70%. And the rest of the market in crypto, ex Bitcoin. So you're starting to get a separation from Bitcoin. And I've said repeatedly, the two things I'm interested in, this is where we segue into the last part. I am a big believer that this year is the network effects year. We will have the administration helping. Network effects will bring more money into the ecosystem. I just focused on the trading side. You have some of the technology with things like Solana and Ethereum and SWI included in the crypto market cap. The meme coins have been destroyed, and a lot of the lesser valued altcoins have. So anyone who was expecting this to be a massive altcoin year, if you're not going to have momentum in technology, I just don't see this being as big a altcoin year as people thought, but I do think this is a big Bitcoin year, and the reason is because I think the ecosystem of stablecoins, this is the stablecoin chart. So remember, as Bitcoin and as the altcoins were going down, you've had a rally that's gone up. Last year, we had sideways action in Bitcoin throughout here, and stablecoins went sideways. Well, stablecoins are making new highs, and I think this is becoming the most important story, and one of the reasons is the stablecoin bill is what they're working on now. So everyone had been focused on a strategic Bitcoin reserve. I just don't expect there to be any kind of announcement on that. I think, as I said last week, you'll get corporate adoption, you're going to get institutional adoption, but I think stablecoin regulation is going to continue to bring more wallets, more money in there, and I think the volumes are going to be large. So the stablecoin regulation is important for Bitcoin. It's important for the entire crypto market, but I think people should be spending more time on it. I'm going to do a long form piece, written piece in Substack if people are interested very soon. But you can go through the reasons why. There's just a lot more stories on it. All in podcast. Back in October, I did a short video, the only short video I've done to talk about the importance of stablecoin future with Stripe buying Bridge. Well, they had the Stripe brothers on who run the company. Good to listen to. I would go listen to it. It was on the All In podcast. At the very beginning, they talk about stablecoins. AI development, I've talked about agents. This is going to lead to much more volumes with inside stablecoin because you're going to have AI agents that are doing a lot of things around the globe. Just in terms of institutional crypto investment, this will unlock, as we go through this, real world assets. So RWA's tokenization is going to accelerate, in my opinion, on the back of stablecoin because you're going to have the banks going in. The banks are going to visit everyone with inside the crypto world, particularly on the asset management side, to understand the custody side. In terms of the other place that stablecoins are already being used by big name places, SpaceX is using them as a currency hedge. So again, if you're a company like Google and you have offices overseas in China or in any country where you're more worried about the currency, any of the emerging markets, and you do transactions over there, you can just put your money into dollar-based stablecoins and all of a sudden your currency's hedged and you don't have to go out and do FX transactions. So I think this is going to grow. That's the way SpaceX is using it at this point, and that's been out there and he's talked about it. So why he's using them, no currency risk. And I think that's a big deal because they're cheaper, they're better for companies. Every transaction that you do, if you want to get your money back, this way you can get your money back in the States if you wanted a much cheaper thing, especially if you want to make investments and don't have to keep it inside the country. So the cross-currency side is there. And then finally, I did do a Substack this week on the inflation dilemma and the things I've talked about in here. The combination of inflation going higher, which is a sticky thing at the same time, and that's because of fiscal dominance and right now where we are with commodities, and at the same time the squeeze that's coming from AI on small businesses. I didn't show the small cap stocks, but that has been a weaker thing all year, and I think what you're getting is continued squeeze on things, median voters, everything. I talk about the rise of Bitcoin in a broken system. I talk about why I think last week was important. So you can get it all there. That's it for me this week. The main message to take out is I think we're in a regime shift that's going to last for at least 3 months, maybe longer. It doesn't mean the market's going to go down. If it did go down, I'd be focused on the 100-day and 200-day moving averages for support. But if we start to break down, I'll give it in. But I definitely think we're in a change for the market where overvalued names are going to have a much, much higher hurdle to go higher on, even if they produce earnings, because I just don't think, I think too much was built in and not enough was built into slowing growth and higher inflation. That's it for this week.